Welcome back to our lecture for Chapter 7 on plant assets and intangibles. We're going to talk about plant asset disposals. Before you dispose of an asset, what you need to do is you need to bring the depreciation up to date. So that will give us a final book value. So we're going to record the expense up until the date of the asset. Then the key is you have to remove the asset account and you have to remove the accumulated depreciation account, as you see here. So remember, an asset has a debit balance and the accumulated depreciation account has a credit balance. So to remove them, you're going to do the opposite. So if an asset has been fully depreciated, meaning that there's no more depreciation to take and no proceeds, then in this illustration, you'll see the finals year depreciation expense has been recorded for a $60,000 cost asset, which has a zero as a residual value. So that means that the accumulated depreciation, since it is fully depreciated, has to equal $60,000 because our residual value is zero. So if we're disposing of it, we're just going to debit accumulated depreciation, and then we're going to credit the asset. This is one of the easiest entries to do when the asset is fully depreciated and basically we didn't get any money out of it. But now, if we have a gain or loss to the asset, then it's reported as other income or other expense, or gain or loss on disposal of equipment. So here, if we dispose of equipment that had a cost of $60,000, the accumulated depreciation is $50,000, and the book value is therefore $10,000. But we're junking this equipment because it results in a loss on the books, right? So we have our $50,000 that comes out of accumulated depreciation. We need to debit loss on the disposal of the equipment because the equipment is $60,000 and we have to take the full amount out. So basically your debits have to equal your credits, and they do here. They're both 60, but because we have to add the loss in here. So obviously if you're selling an asset and you're getting cash and that's greater than your book value, you have a gain. If it's less, you have a loss. So now we're just going to talk about selling a plant asset. So here we sell equipment, which on September 30th, and now we have $7,300 cash. So cash is going up in this case. The equipment cost us $10,000 when it was purchased on January 1st, 2011, and has been depreciated a straight line. So they estimated when we did that a 10-year useful life with no residual value. So in this case, if the cost is $10,000, no residual value, then we know that basically for 10 years, that's $1,000 a year. So partial year depreciation must be recorded for the asset's depreciation from January 1st to September 30th. So that would be again 9/12, right? Because we have 9 months. And so now the depreciation entry is going to be, we take the $10,000 divided by the 10 years, which is 1,000, and 9/12 gives us 750. So we need to record the depreciation first to bring it up to the current. And then the estimated book value will be $6,250, right? We have the $10,000 here, and we have the depreciation for all the years, and now our partial year. So here we have the cash received of the $7,300. The book value, we have $6,250. So our gain is going to be $1,050. So in this case, we're taking the $7,300 that we got for cash. We are going to debit accumulated depreciation for the $3,750, credit our $10,000 asset, and then show our gain of $1,050. So if we do the same situation now that we are on January 2nd, and Crystal of Vermont, they had purchased $8,700 for fixtures for cash, and we expected the fixtures to remain in service for 5 years, and they had depreciated the fixtures on a double declining balance basis with an $1,800 estimated residual value. So on September 30th, 2015, we actually sold the fixtures for $2,600. So here we have to record the depreciation expense for 2015 and the sale of the fixtures. So apart from the journal entry, they want to show us how we computed it. So let's see here. So we have the $8,700, and we know double declining balance because 5 years. So this is 1 divided by 5 times 2. So this was our annual expense for 2014. And now for 2015, we start here. But the only thing we need to add is the 9 months, right? Because September 30th is when we sold it. So in 9 months, we get these two as our current year. And so we have our accumulated depreciation. So our book value is $36.54. So now how we computed the gain or loss, we had the $2,600 and then we subtract to that the $3,650. So we basically have $1,054 loss. And then our depreciation expense is going to be the 1,566. And if we go back to our schedule here, you'll see our 1,566. So that's our depreciation expense debit, credit, accumulated depreciation. We have cash of $2,600 and our accumulated depreciation of $5,046. You'll see that right here. So you're just basically using your depreciation schedule to plug in your numbers here. We have the loss that we computed. We're taking off the assets, the furniture and fixtures of $8,700. So please make sure you understand this. Now, when you are exchanging a plant asset, if older assets are traded for newer assets, if it's a non-monetary exchange, you just have to make sure that you account for it. If the cost of the asset received is equal to the fair value of the asset is given up, then you just record the old asset and any cash paid. And the difference between fair value of the old asset and its book value is a gain or loss. So when you are exchanging plant assets, in this case, Papa John trades in the old automobile for a new one with a fair market value of $15,000 here. We paid $10,000, but the old had a cost of $9,000 and had accumulated depreciation of the $8,000. That's what we see here. Then we have our auto of the $9,000. So you got to get rid of the old asset and make sure you add the new asset in, and make sure you include the $10,000 that it paid. So remember, you have to remove the old asset no matter what because you got rid of it. And then make sure that you add the new asset so that your fixed assets are properly reflected on your balance sheet. And then you see here all the various transactions, and basically the building here is going to be your cost of the building. So if you purchased it, it gets added. If you dispose of it, it gets reduced. And accumulated depreciation, remember, it is a debit balance. So when you're adding depreciation expense as a credit, and when you dispose of the asset, you're debiting it. And then cash, you're either getting proceeds or paying long-term debt. If you incurred new debt for the asset, that's long-term debt is a liability account. So it does have a credit balance. Gain is basically like other income, so that has a credit balance. Loss has a debit, and depreciation expense has a debit balance. So hopefully that helps you understand all of the accounts. And now we are going to move to our gap for intangible assets. So intangible means there's really no physical form, and that includes patents, copyrights, and franchises. And then you have categories of lives, a finite life and an infinite life. So basically, if you have a finite life, you record straight line method, and then the intangible asset is reduced directly. So in an amortization, you have handled a little differently. Infinite lives, you have to test for impairment, meaning is it still a value to the company, and if so, then you have to reduce it. So patents are granted by the federal government, and they're usually for the legal life of 20 years. So that would be your useful life. So when we're looking at paying, we paid $170,000 to acquire a patent, and the business believes the expected useful life is 5 years, not the 20 years that it's given. So our amortization expense is $34,000 per year, right? Because we take the 170 and we divide it by 5. So in this case, you are recording it debit to patents, and you're crediting cash when you purchased it. But then for your amortization expense, you have patents of $34,000, and then here, unlike depreciation, you recorded the usage directly to the asset account, in this case patents. So make sure that you don't have accumulated amortization. There is no such account. For intangible assets, you record the amortization expense directly to the asset. So that means you credit the asset. For copyrights, it's also given by the federal government, and here you have 70 years after the life's creator, but most of the times it's considered a lot less. And then trademarks are just that identification of the product, probably the golden arches you're quite familiar with, the swoosh for Nike. And then here the useful life is usually set by the contract. And you'll see the little TM or the R symbol for these. And then franchises and licenses, sometimes you're given like the authority to use a name like Subway or McDonald's. And then this sometimes has an infinite life, or sometimes they have like a set schedule as well. And goodwill is only recorded when a company is purchased, okay? And what goodwill is basically whatever you paid for the company, any excess of the market value of the net asset. So this is like the earning power of the company. Goodwill is not amortized, so it's basically your purchase price less the market value of the net assets. And it is not amortized, so make sure you know that. And we will pick up in our next lecture. We'll end this lecture and pick up in our next video lecture.